Well, when you think about how high interest rates have risen, or at least treasury yields have risen over the course of the year, how much the dollar has strengthened, to be honest, it has not been that bad of a year for emerging markets. Typically, you would expect many more crises in countries, and certainly there's been isolated examples. Not coincidentally, countries that tend to be commodity importers who already had high levels of dollar-denominated debt, so no surprise there. But by and large, the economic outlook from our point of view is still reasonably good. We are also overweight commodities, which is then a key support for a lot of these countries. And another thing to keep in mind is around inflation. Number one, I think you can argue that inflation is actually more of a problem in the US and in Europe than it is necessarily, on a relative basis in the rest of emerging markets. And secondarily, many emerging market central banks were more proactive in raising rates in contrast to the Fed, and that gives them scope, hopefully next year, then to be lowering rates.
Last question, Daniel. Last time around we were talking along the lines of everything is very expensive, where to find still interesting opportunities. Now everything is, or almost everything is cheap, quote unquote, meaning there was a significant sell-off. So where's the value now? Where would you say makes sense to buy already?
Yeah, well, there's not much I honestly would characterize it as cheap. Certainly not expensive anymore. So, if we take equities, growth equities, tech equities, you've gone from a forward PE of 31 or 32 times, which you last had in 1999, to today where it's around 20 to 22 times, which is an average. Okay, so I think closer to fair value today. And certainly on the equity side, what you're anticipating is honestly more declines in equities in the first part of the year as earnings expectations reflect what is for us still a poor growth outlook. But as equities do, they will bottom and they will recover. But we think that kind of big moment where you want to significantly overweight equities for that recovery is probably, hopefully, some point in the months ahead, but not quite yet. Otherwise, it is, I think, selective valuation opportunities. China actually is probably one of those. One reason we are overweight Chinese equities is particularly within the tech sector. Again, on a relative basis, technology shares do look inexpensive relative to the rest of the world, and particularly the US. So that would probably be the other key area where we think there is an opportunity simply looking at valuation.